Okay, I'm back. What I'm going to teach you now is how a hybrid annuity came into existence. You remember when we talked about the fixed indexed annuity and how you had to put your money in each bucket and how the market moved and how you move your money around in each bucket based on how you think the market might go? Well, what they did back a few years ago is they took a fixed indexed annuity and they added a feature. Now I'm going to erase this. They added a feature to it called a rider. Now a rider is an extra little insurance policy that gives you guarantees. Now a fixed indexed annuity is guaranteed, meaning that any money that you put in it is safe and guaranteed, and any interest that you make is safe and guaranteed. It's based on the claims paying ability of the insurance company, of course. But if the market goes down one year, that might be a year where you don't make any money, but you don't lose anything. You keep what you had the year before because it's locked in, it's interest. Now, here's what happened. Back a few years ago, remember we were talking about the buckets here, okay? And how you put your money in the buckets. And we switch these buckets up every year. And every year, you're going to get different amounts of interest. And every year it's locked in. So some years you're going to do really well, some years you won't do so well. Now, what they did is they added a rider. They give you the option of having an income rider that you could attach to your fixed indexed annuity, and it became a hybrid annuity. Okay? Now, there are different income riders that you can add to them. Some have more bells and whistles on them than others, but I'm going to give you the general overview. When you add an income rider to an indexed annuity, it now becomes a hybrid annuity, meaning that it will give you a guarantee of some number. I'm just going to say 7 here, okay? And what this means is that every year on the back burner, so to speak, okay, we're working and we're trying to get your account to grow every year. And on the back burner over here, there's this underlying guarantee of 7%. This is an example. This just means that at some time in the future, if for whatever reason you haven't made at least 7%, this is an underlying guarantee that you'll make at least 7%. Now, here's the catch. This is an income rider, meaning that whatever this value is, whenever you decide to start taking out income, okay, the only way you can get this amount over here is to take it out in a form of income. If you want to go get a lump sum, you have to take this amount out. What's happened now is, used to, if you died, then your beneficiary would get this amount. They wouldn't get this side. But now the newer riders that have come out not only give you a guarantee of a minimum that you can take out in the form of income, but they also allow you to transfer that income to your spouse. Now there are certain conditions as how they have to take it out. Some of them have to take it out over a period of 5 years to get this amount here. But there's other bells and whistles. But this became a hybrid annuity because when you start taking your income in this account, okay, you can take lifetime income. But if you decide that you don't want it or you win the lottery and you want to turn this off, you can completely turn this off, and then you can go back to taking free withdrawals out of the value on this side here. So if you have $150,000 over here and you have $180,000 over here, and you want to take out, just go in and take out some money, you can typically take out around $18,000 of your account value. Now again, every insurance company and every annuity works a little bit different as far as whether it's 10% of account value or initial premium. But typically you always have access to 10% of what you have over here. To have access to this, you have to take it out in a form of income. But when you come in, or anybody that you go see, but if you come to see me, when I decide how much needs to go into an annuity, you know, I take your age into consideration, your health into consideration, how much you have in liquidity, when you're going to start taking out money, and how much this is going to be able to grow, okay, to try to hit that target of how much income that you're going to need. So this is how a hybrid annuity came into existence.